How can municipal bonds be part of a tax-efficient investment strategy? If you're looking to optimize your investment portfolio and minimize your tax burden, you might be wondering how municipal bonds can fit into your strategy. Let's break it down to see how these bonds can be a smart choice. First, it's important to understand that municipal bonds are debt securities issued by local governments, such as cities, counties, and states, to fund public projects like schools, hospitals, and highways. One of the key benefits of these bonds is their tax treatment. Municipal bonds are generally exempt from federal income taxes. This means that the interest you earn from these bonds is not subject to federal taxation, which can significantly reduce your tax liability. For investors in higher tax brackets, this tax exemption can be particularly beneficial. Since the interest earned is not taxed at the federal level, it can provide a higher after-tax return compared to taxable investments. For example, if you're in a 24% federal tax bracket, a 3% yield on a municipal bond could be equivalent to a 3.95% yield on a taxable bond. In addition to federal tax exemptions, many municipal bonds are also exempt from state and local taxes if you live in the state where the bond was issued. This can further reduce your overall tax burden. However, if you buy municipal bonds from another state, your home state might tax the interest income. Another advantage of municipal bonds is their generally lower default rates compared to other types of bonds. This makes them a safer investment option, which can be appealing to investors who are risk-averse or nearing retirement. To determine whether a municipal bond is a better option for you than a taxable bond, you can use the tax equivalent yield (TEY) formula. This formula helps you compare the after-tax return of a taxable investment to the tax-free return of a municipal bond. Essentially, it shows you how much more a taxable bond would need to yield to match the after-tax return of a municipal bond. It's also worth noting that while most municipal bonds are tax-exempt, there are some exceptions. For instance, bonds issued for certain private activities, such as financing stadiums or investor-led housing projects, may not qualify for federal tax exemption. These bonds are known as taxable municipal bonds and do not offer the same tax benefits. In summary, municipal bonds can be a great addition to a tax-efficient investment strategy due to their federal and often state tax exemptions, lower default rates, and the ability to compare their returns to taxable investments using the tax equivalent yield formula. By incorporating these bonds into your portfolio, you can potentially reduce your tax liability and maximize your after-tax returns.